Good evening, everyone, and thank you very much for joining us tonight. The session tonight is a second in the series of the Masterclass, and we're going to be focused on talking tonight about option strategies. My name's Patrick Nelson. I'm representing Reach Markets on the session tonight. Graham O'Brien's going to be doing the lion's share of the talking. Graham is the Senior Manager for Equity Derivatives, and we were also joined by Ivan Trurilove from Trade Floor, and
okay, that is the worst way you've ever pronounced my surname.
I'm usually pretty good. Cherry Love.
Cherry Love.
Yeah. We just call him Ivan.
Yeah.
And he's the managing director and co-founder of Trade Floor, amongst many other things these days, but has also built the technology that if you're playing the options trading game that you're using, or if you use our system, the implied volatility, you're using Ivan's technology as well. So
you're really just making it up now for pronouncing my surname, aren't you?
You're taking this to heart, aren't you? Anyway, that's probably one of about 5 people in Australia that can pronounce your surname. So anyway, so tonight's session is focused on options strategies. So Graham's going to go through and do some education on that, and then we're going to be looking at some strategies, some of our trading systems, and we're going to go into the options game. We're going to have a look at the leaderboard, some of the trades that have been done recently, take questions.
In particular, there's one big trade we'll talk about.
There is one massive trade. I don't know. Have you seen a bigger trade than that in the game?
Never.
Never.
No. Oh, sorry. Let me just make this very clear.
A legitimate trade.
A legitimate trade has never been this big. We've had some big traders.
We've had a few hackers put trades in, but this is a legitimately big trade. So we're going to go in and have a look at that and unpack that. And also is, the session's open to questions. So please, any questions you've got, type them in as we go. We'll try and answer them as we go, but probably get to most things as we come out of the session through Graham's session. So let me just go through some housekeeping. So if you don't have your chat box open, red arrow top right hand corner of your screen, click on that, it'll open it, and type away as you've got questions. Any advice contained in the presentation is general only, doesn't take into consideration your personal circumstances, and you need to decide for yourself whether it's appropriate to you, and past returns are not an accurate indicator of future returns. And we have the disclaimer for the ASX, which we'll just leave up there for just one moment as we move on.
Would you like to read it? Is there a thing? Do you read it usually, Graham?
No, I never ever read it. It's one of those that is effectively the same as the Reach Markets disclaimer.
It's education only.
It's education only, and we can't give specific financial advice. So if you're wanting specific financial advice, seek out an advisor.
Yep.
All right, I think we're good. Ivan, can you bring the questions across?
I can.
Yep. Sorry, we're fiddling around with our screen here. Beautiful. All right, guys, let's go. Graham, I'll hand over to Graham O'Brien.
Thank you, Patrick. Well, it's actually good for the three of us to be in the same room for once. Normally I'm in Sydney and you guys at home in Melbourne.
Well, usually Patrick's actually in the office finishing up his day. I was during my quieter periods, which are all about to end.
Yeah.
For me.
Yeah. Oh, it's good to be in the office together anyway. So we're going to look into some more advanced trading strategies in this particular session, but I thought I'd start out again by looking at the actual trading hours of the physical market itself. So when we think about options over single stocks, market opens in line with the staggered opening of each individual share in the market. So they all start at 10 a.m. in the morning. For the game players, we only start the game at 20 past 10. And I know in next week's webinar, we're really going to go into details about market making. But the reason the game starts at 20 past 10 is because that's when market makers are obligated to start quoting in the options market. Options trading in single stocks anyway go all the way through until 20 past 4. So they're open a little bit later than the underlying equity market. Forget about late trading as retail investors. And then for index options, so options over the S&P ASX 200 index, they open before the physical market opens. Our futures market opens at 9:45 in the morning. We open the options at 9:50. And they trade through until 5 p.m. When we're entering orders in the market, and I know you're doing that via the game at the moment, but when you're entering orders necessarily through brokers in the market, there's a couple of ways that we can enter orders. If you're entering an into an individual series, every order that's entered onto the ASX market is all done at price time priority. And what I mean there is that whatever is the best price entered first is traded first in ASX's markets. And we can see some outright markets here just from examples in BHP. So that very top one, 191.5 bid, 213.5 offered. You can trade somewhere in between those levels when you're putting your orders into the marketplace. The most common way, though, that people actually enter orders is not in individual series. It's actually in things that we call tailor-made combinations. And I want to touch on that first because I know the trading strategies we're looking at here this evening are actually involved in combinations of trades where we're actually buying some series, selling other series in the marketplace. And the important thing here is to do all of those transactions all at the same time. So you can actually trade up to 4 series all at the same time in ASX's markets, all for a net price. So we can actually ensure that you get the deal that you want to get done at the price that you want to do it without missing on any particular legs. And that's why we have these things called tailor-made combinations. So it really does provide us the flexibility to enter into trading strategies that we're looking at here this evening, all traded through the same trading platform as the individual series, but allows for us to really ensure the most accurate price that we want to trade in each individual tailor-made combination. So some quick rules when we're entering these types of orders in the market. They have to have up to 4 legs and no more. So obviously they need to be more than 1 leg because it's a combination. So 2 to 4 legs is what we need. They can only have the same contract size, and sometimes we change contract sizes on ASX's contracts due to corporate actions. So they all have to have exactly the same contract size. And then finally, they need to have up to a 4-to-1 ratio. So you can buy 1 leg and sell 4 of another. The beauty about tailor-made combinations, though, is they interact with each individual series in our marketplace on that individual base. And they do that via this thing called derived orders. And they really can occur whenever you can trade individual legs in the market. And I think some of the easiest ways for us to understand that is via an example. So I've got an example here of someone who's doing a simple buy and write. So I'm wanting to buy stock and sell 100 calls, or calls priced at 100. So I can go and buy stock and I can go and sell that call. If I buy stock at 108 and I sell calls at 101, the net price at which I can transact that at is 7 cents. So I could effectively go and buy 500 stock and sell 5 call options for 7 cents. Let's say that we actually want to buy 9 call options and buy 900 shares in the physical stock. Let's see how that derived order might work in our marketplace. So first of all, we would transact those 5 lots that were on the offer at 101 and those 500 shares that were on the offer at 108. That would automatically transact at the marketplace because we have that 7 cent net price that's worked. The trading platform, however, will then create an additional order to actually sell 4 at 102, knowing that if they can buy shares at 109 and sell options at 102, it will still meet our net price in the marketplace. So really the client is looking to buy those 900 shares and it will transact at that particular price. So the first order trades 4 at 102, transactions occur in the market, and then we actually get our entire fill of those 900 shares. The first ones in the automatic market, bought shares at 108, sold call options at 101, then the additional orders that got transacted because someone's actually sold to our options contract. So we bought 400 shares at 109 and we sold 4 options at 102. The beauty about derived orders is they really ensure that we have the best possible chance for our trade to transact, even if it's only individual series that are transacting in the market. Also, some of the trading strategies that we're looking at involve margin. And I thought it's important to understand margin. And really, that's the reason why the options trading game started out in the first place, Ivan. You built a platform that actually understands ASX's margining system, which we could then build a game off the back of because lots of people like selling options and taking on risk.
Yes,
and we need to ensure that people have the right amount of cash to cover their margins.
I've actually got to say, you know, my career in trade floor would have not been in the same place if not for the ASX margining system coming out. And it's interesting. It was amazing when we started doing this, how few people understood the impact of volatility to options portfolio, especially in the professional market, let alone the retail market. And it was the right change that ASX had to make, and the entire industry just wasn't really as prepared as it should have been.
No, not really. This volatility was a new term, and pretty much all options are priced off of volatility, so it's interesting.
It's amazing. Obviously, in the next session, we're talking about market makers, and that's exactly what they trade. So
you're spot on.
Yeah.
So margins, it's important to us to understand as options game players as well, only because you've got that $50,000 to play with. You need to ensure that you have enough cash left over at the end of each day to cover the margins that will be required on each individual position. So before I get into margins, I thought I'd touch on some terminology first. Now, the most important ones for us as investors are premium margin and initial margin. Total margin obligation is basically those two added together. Additional initial margins are just problems for your brokers. So you don't have to worry about that as individual investors. And then the margin multiplier is important for you because your broker will often charge a multiplier over ASX's minimums. What I'm going to focus on is the premium margin and initial margin. Premium margin is really simple for us to calculate. What is the option worth from one trading session to another? That's effectively what your premium margin is going to be. So if you held on to an option yesterday, it was trading at $1 and you shorted that particular option, and then today it's worth $2, your premium margin is going to be $1, the difference between that 1 and 2. Initial margin is the difficult part that really is what the game's based off the back of in determining that initial margin. So total derivatives margin again, premium margin plus initial margins gives us how much margin we're going to have to actually give our brokers to be able to hold on to our positions. At ASX, we use standard portfolio analysis of risk, or SPAN, to help us in understanding what the initial margin will actually be for investors. And SPAN is made up of a whole different range of variables. We shock the price of a stock, we shock volatility, but you do get some benefits back. We do provide intra-commodity concessions. So when you're actually long some BHP and short some Rio, we'll actually give you an offset between each of those positions. But let's go into have a think about some of the scenarios that can really happen in options land. Each and every day we calculate your portfolio at ASX in each individual share, and we really look to see which scenario would be the worst case for your stock. There's 16 different scenarios that we go through, but the really good thing for us today to understand is that more often than not, ASX is really just focusing on two key scenarios. First of all, the risk if you're actually short the market via an options trade is that the underlying equity price or the share market went up in value. So we will determine how much the market might move up by and what would that impact be on your portfolio. At the same time, we'll also shock volatility, which is one of those key components in options pricing, and we'll reduce time by 2 days. The other style of SPAN margining that we use, or the scenario anyway, is obviously if you're long the market, the risk is that the market will go down. So we shock the market down, once again shock volatility up and reduce time.
And just really quickly, at the end when we're going through the game, I'll actually show you where to see that in a payoff type diagram. We visualize that, so not many people know what 3/3 of a range actually means, and we have a really cool widget for that.
Great.
It shows it turns that into a payoff that shows volatility versus price. It's something that's been really popular since we sort of started. And
brilliant. So I think of 3/3 of a range. Let's look at this price shock that we see here, which is price scan range. We got AGL as an example here of 5%. Let's say AGL was actually 6%. 3/3 of the range is 6%. So we will shock AGL's share price by 6% up or 6% down. What is the worst case on your portfolio if you're holding in the options? That's 3/3 of the range. If it's 1/3 of the range, we actually only shock it 2%. 2/3 of the range, 4%. So that's what we're meaning by 3/3, 2/3, 1/3. More often than not, most clients, it will be the worst case scenario when we shock the entire amount. On individual shares, we do it on a percentage basis, but on the index itself, we actually do it on a points basis. So we do it on absolute returns. At the moment, the index is being shocked around 4.5% if we wanted to do it in percentage terms of how much we would shock. Each individual stock in your portfolio will have a different price scan range depending on the historical movement of that underlying share. And what we're trying to cover for is a potential 2-day movement in the underlying share price via that price scan range. But importantly, the other thing that takes into account of how we revalue an option is the volatility scan range. And we all know that obviously when markets move around, volatility changes as well. So we also shock the volatility, and in most cases, we're always increasing the volatility on our portfolio. So in the case of the S&P ASX 200 index or XJO, we would shock it by 40%. At the moment, you're looking at around about a 10 to 12% volatility. Let's say it's 10%. Shocking it by 40% means we revalue that option at an implied volatility of 14%. So,
and that's
really
actually
simple.
really important because a lot of people think that a price scan range of 40% means it goes from 12 to 52, right? So it's, and we've had a lot of, again, professionals asking that question. So very important.
That's right. Now the good thing about playing the game is all of these calculations that happens in the background of ASX's margins is happening within the game itself.
In real time.
So you can get a real-time scenario of what we would be charging as a minimum from an ASX perspective of the risk in the market. Yeah. And a lot of people will say, why do I pay margins? And effectively, ASX is guaranteeing contracts in the market. So you might buy through your broker. You're at risk to your broker. Understand that. However, you're not at risk to the person that sold you that particular contract. ASX steps in between that scenario, and we become the seller to every buyer and the buyer to every seller. So we make sure we margin the sellers to ensure that there's enough cash in the case of default in the market.
And it's interesting, again, sorry, just to bump in on your slides, it's amazing how frequently I've seen people in the market be really close to the edge of full capital, whereas the margining system is a really good way for your ability to risk manage your portfolio. If you've got one trade and it's taking up $50,000 and that's all you've got in your bank, you probably over leveraged, right?
You probably over leveraged, but isn't that the way you win the game?
That's true. Okay, if 50,000 is real money, then you're pretty much not trading options as a business. You're trading it like a gambling.
That's exactly right. You always what you're trading is what you're willing to lose. If it's a trading particular strategy, it's not your entire cash pool. Yeah.
But speaking of which, hopefully by next game or the game after latest, we'll move over from an absolute performance to an actual participation, gamification point of view. But we've got plenty of work to do on that side.
That'll be nice.
But then people like today. Anyway, we'll talk about that later.
We're going to get into strategies very shortly. I'm spending too much time on margins, but it's really important that people that are trading risky positions understand them. The slides I have here are really looking at the spread parameters and the offsets that you get. So I mentioned before BHP and Rio. So if I'm long BHP and I'm short Rio, I'm going to get a 40% offset between those particular positions over that time. Ignore the date on the screen. It's still the same today. We don't change those parameters around that much. If you're doing inter-month spreads on ASX, you actually get charged for inter-month spreads on the index only.
Yep.
Now, I know we're focusing on margin maybe more than we intended to, but one way of working, you might be looking at that and go, how would I work that out, Ivan?
No, just look at the screen.
The screen.
And shocks and...
IV, you'd go into IV, implied volatility, or the options game. You load your position up and it will tell you. Yeah. Don't make clicking noises.
No. I mean, come closer to the microphone. Someone mentioned that it's hard to hear. So
short option minimum. Easiest thing to think about here. We will only ever value an option down to 1 cent. So if you think the option's only worth 0.1 of a cent, ASX is still going to value it at 1 cent or 1 point in index.
Imagine all those things we can do with that.
That's right. So what we really come for in this session, strategies. And I think it's really important that we start thinking about some more advanced strategies, especially when we've got the opportunity to be able to play them in the game. That's the best time to test out some of the more complicated strategies that you mightn't understand in a game environment. So The strategies we're going to look at are the more complex trading strategies. ASIC actually have in their market integrity rules, or the Australian Securities Investment Commission, that if you are getting advice when it comes to the strategies we're going to be looking at now, you will need an advisor that has level 2 accreditation. So
You got yours yet, Patrick?
Got one a long time ago.
Yeah, good.
Yeah.
Still valid?
My CPD is up to date. I don't know about yours.
Okay, yeah.
So if you are getting advice, make sure your advisor is level 2 accredited before you do these trading strategies. So we're going to look at those combination trades where you have more than one position. I touched on tailor-made combinations. However, it isn't uncommon to add legs post the initial trade. So you could actually end up in a combination trade even though I didn't start in that particular way. There's a whole range of different combination trades that you could actually start thinking about. We're going to focus on the moderate bull market, moderate bear market trades. We're also going to look at neutral market trades. So we're actually going to look at selling straddles and strangles rather than buying straddles and strangles. Importantly, when we're doing a moderate bull market, if you're using calls in that moderate bull market, you're going to be paying money. You're not going to have to worry about margins. If you're using puts on that trade, you're going to be receiving money and you're actually going to have to pay margins in that case. I think the easiest way when I start thinking about combinations is whether I'm going to have to meet margins or not. Have you paid money for that trade? Generally, it means you're not going to have to worry about margins. However, if you've received money from that trade, you are going to have to meet the margins that we met before.
And
general rule,
more.
yeah. Generally a bit more. You're exactly right.
Yeah.
So let's have a first look at bull and bear spreads. So why would someone actually implement a bull or bear spread? And I think the easiest way to start thinking about that is if we compare it to actually buying a call option versus buying a bull call spread. Quite often call options can be expensive. And when you're buying a call option, you're actually buying the unlimited potential of that stock going up in value.
Straight to the moon.
So if I actually don't think it's going to the moon and I think it might actually be moving up in a moderately bullish environment, I'm actually going to be better off through buying a bull call spread in my overall percentage return because it's going to reduce my cost and give me a much better profit potential. Bull put spreads, on the other hand, rather than just selling a put option and hoping to generate income, it's going to reduce that risk of holding a sold put, but still be able to profit if there's been a moderate price rise in the marketplace. Where we're entering into bull put spreads, once again, there's going to be margin obligation, so we need to be mindful of that. So we're going to pay a net premium when we do the bull call. We're going to receive a net premium when we do a bull put. No margins bull call, yes margins bull put. And really, our maximum profit in both cases is going to be the difference between the two strikes. So let's have a look at why we do it. Straight bull call example. We've got this market that's jumping all over the place that we can see here. It might move from out of the money to in the money, above and below the strike price. The only time you're going to be making profit at expiry is when it's above your strike price. But when we start implementing things like bull call spreads, we'll actually start being able to make money in between those two strikes. And more often than not, the stock's going to be remaining in between those two levels. So you're going to have a profit that's capped, obviously, but your range of where you're actually going to make a profit is actually higher compared to what you actually pay. So that's the real reason why people are starting to get into bull call spreads as opposed to just buying outright calls. Gives you more potential for profit.
You've been doing some great work with the marketing team. I love it. I love the new slides.
We actually built these for the brokers. Can you believe that? So not even for a retail customer to actually teach the brokers of strategies they should be considering.
Moving on.
So bear spreads. So we've looked at bull spreads. Let's have a think about bear spreads. So similar to that bull call spread, I'm paying money, but think about if I think the market's actually going to fall, I can go and buy a put. What am I buying in that put? I'm buying the likelihood of the stock falling to zero again. But do you think the stock is actually going to fall to zero when we're talking about some of our blue chip shares that we have on ASX? So they can help to reduce the cost of that outright put purchase. The bear call spread, on the other hand, it's like selling a call option naked. Can't get any riskier. Potential for the stock to go unlimited. So the way I reduce that risk is by selling another call option above where the market's trading to actually reduce some of that risk.
Just quickly on this, it's interesting. We get a lot of clients always asking about stop losses on options. And effectively, this is a good way of looking at it. It's an inherent stop loss. That is the worst case scenario. You're capping your your maximum loss. You're capping your maximum profit as well. But it works as that inherent stop loss, so you can sleep at night and not worry about the market rallying.
You're exactly right. Between these two trades, the most you can make is between both the bought and call position. With a bear put in this particular case, we're actually going to make what is the difference between the two strikes less what the cost of was that trade was. A bear call spread, on the other hand, I'm making the most I can make is what I received from the trade. The most I can lose is the difference between the two strikes less what I received. So it's pretty much the same thing.
And much more precise trading, ultimately.
Correct. People love doing this on the index. There's no chance of early exercise. People kind of have more of an opinion on the index. The index kind of has inbuilt protection of it moving too far because you have some sectors going up and down. Index is definitely a way that people trade these particular options. So same thing again. So bear put, think we want the market to go down, so you're going to purchase a put. It's actually going to be paying that premium up front. You're not going to have margins. The bear call, on the other hand, is you're going to be receiving money from the trade. You will have margins from that particular transaction. Similar to the previous trade we saw, bought put, the only time you're going to make money is when it's below the strike in this particular case. But when we start thinking about the bear spread itself, you're making money when it's in between those two trades. So more of a range for you to be able to profit from the smaller outlay that we're doing in that bear trade.
We did some analysis on this, by the way, as well. And even this was, I think, not 2 games ago or 3 games ago when the market fell off during, end of last year, I think it was actually the period. And by comparison, buying an XGO put option versus a predefined half a standard deviation, kind of the thing that you get out of the options school book, bear put spread. We were doing a bear call sold spread. Significantly outperformed despite the market really falling. Hopefully I got my puts in. I was going through this. It's been a long couple of days. Point is that bought put underperformed the predefined sold spread.
Yeah, that's interesting because generally you'd see that on the call.
Time decay.
But you generally see that in the call because generally markets go up, volatility comes off, so that impacts on that trade. When markets go down, volatility goes up. So generally it's the extra kicker for the put. So it's interesting.
And it was because right near the expiry, the market sort of started coming back a little bit and it sort of grinded into the final.
So close to expiry, time decay just ate away at it.
Yeah, it is. Yeah. And so it's interesting. And again, you go into the back test, so you can go through all of this, 3 years of data and just compare during different times. Yeah. It's interesting. We've done some interesting stuff with that.
Great. So before we get on to the other one and for everyone else, a neutral market, buyers of spreads might limit profit, but remember you're not paying as much for the trade, so you get a bigger percentage return on your trade. Sellers of spreads limit their risk. So rather than having a naked option position that could be very risky, I'm limiting my risk in that particular case. But it's all about trying to take advantage of a limited stock price movement rather than the unlimited potential that you get from just buying options in the market. So short straddles and strangles. We're now getting into things that can be risky. I remember when I first started in the market, we had some guru come out from Chicago, which is where options started out at. And he spoke about short straddles and strangles, that like these are actually instruments that more often than not, you're actually going to make money from shorting a straddle or a strangle. So 90% of the time, you're actually going to make money from the trade.
90% of the time works every time.
Oh, I know. There's some smoke and some mirrors.
Correct. But he did tell us about the other 10% of the time. So 5% of the time, you're gonna lose a shitload of money.
Yep.
The other 2% of the time, you're gonna lose your house and your car. And the other 3% of the time, you lose your wife, your family, and the rest. So it's interesting that we've got a trade that more often than not people profit from, but it's really risky.
Yeah.
So we're going to go into what it is about that trade, and I'm going to leave it with you guys to really think about ways that we might be able to reduce the risk on the trade itself.
And of course, the guys that invented the BSM, the
You're
Black
telling me.
Scholes model.
Oh, Black-Scholes model. Yeah.
Black-Scholes models. Yeah, 2 of those guys were part of the fund that blew up specifically doing short straddles. And these guys won the Nobel Peace Prize. Sorry, the Nobel Prize for options theory.
So the only time you short a straddle or a strangle is when you think the market's going to move nowhere. So a 2.5% movement in the market today, most of those clients would be burnt from doing this trading. However, more often than not, markets do kind of trend in a neutral to moderately bullish, moderately bearish market, and it remains within those ranges. So your maximum profit from this trade will only ever be the premium that you receive. But effectively, you're selling calls and puts at the same time. So your sold call, if it's naked, don't own any stock, effectively you've got unlimited risk if the stock goes to the moon. And the sold put side, you're only limited by the stock falling to zero. So you can't get a riskier trade than this one.
Imagine those.
The only way you can make money on this strategy is if you leave the casino.
How good was the, imagine doing that on Coltex a little while ago before it collapsed and then had the whoa, it's coming. And
So what we're hoping for is a market that's range bound, not jumping all over the place that we can see on the screen here. Anything in between when we're going to make money, anything outside is when you're going to lose money. The difference between the straddle and strangle part, straddles use both at the money options, strangles use both out of the money options. So it gives you a little bit of protection, but not much from a bigger movement in the market. So definitely consideration again, I have to touch on it. It is one of the riskiest trades you can enter. Whilst you can profit from a trade of a large fall or rise in the market, this can create significant losses for a portfolio itself. Importantly, I would start thinking about adding strikes even before implementing it to protect yourself from that large amount of risk that you have, or at least once you've put on the trade, if the market starts moving against you, if the market's fallen, start thinking about adding in some out of the money puts, or if the market's increased, start thinking about adding in some out of the money calls. But it is a strategy that sometimes when markets aren't doing all that much, people really start getting involved with, but it's high risk. So I'm going to leave it to you guys to start thinking about how can we start using this idea of, look, markets don't move that much, but is there a way we can reduce the risk on this portfolio?
Yeah, absolutely. And I think you start thinking about statistics, right? And I'm going to move close to the microphone. What you might say, well, okay, if I use a strategy where I'm selling an out of the money call or an out of the money put, it's going to work for me 80% of the time statistically, or 90% of the time. And then when it goes wrong, I'll roll it away from me and I can make that 95% or 97% of the time. But if I'm a trader and I do 50 trades in a year, well, that means that 2 of these trades are going to get me. And when they get me, they're going to get me good. So it's okay to use a strategy, but you've got to be committed with a trading plan, a trading system that you just keep ticking along. And then you've got your, you're doing it over 50 trades, not over the one. And guess what? The 1 out of 100 seems to happen like
a little bit more often.
Once every 3 months.
I think you're spot on, because the flip side of this trade is a bought, straddle or strangle.
Yeah.
So why would anyone buy something that they're going to lose 90% of the time? It's because of that 2 and 3% that it makes up for all of that other 90%, and they can make plenty of money from that.
So the strategy that this leads into, I think if I'm pressing the right, here we go, is the iron condor versus short straddle. And I guess this is part of your presentation.
Yeah, all right.
I'll let you do the talking.
Do you mind if I just I set up the, sorry, I set up the mic a little bit funny. Anyway, we'll get there. Interesting point about that, but it's interesting, and a lot of people they love the straddle. But anyway, we're going to talk about why there is an alternative to this, which is something again that helps you sleep at night, and really that's iron condor. So a short straddle is effectively an iron condor without the bought legs. And the idea behind an iron condor is where you add a bought deep out of the money put option and a bought deep out of the money call option. So the 2 sold legs in the middle, that's your short straddle or strangle, depending on where you position your strikes. You're effectively giving your inherent stop loss there. the way you trade it will be slightly different. So let's have a look at XJ. This is an example from a little while ago, but the example still stays the same. So the index is trading somewhere about 62.50. We sold a 61.75 put, a 63.75 call. So that's our straddle component. Straddle, and bought 6100 and I bought strangle. Bought a 6100. I'm serious, it's been a long couple of days. Bought a 6100 and put and a 64.75 call. Now we've done a lot of number crunching on this again, and the interesting thing is, again, due to the span margining system, you can actually get a lot more size with an iron condor. So your risk reward is defined, maximum profit versus maximum loss, and also you can get a much better reward for doing the straight. So instead of doing for the same amount of bank, maybe 2 lots for a $5,000 bank, you can actually do 5. So the margining system, which never really used to happen before, now rewards you for doing limited risk strategies. So this is the straddle and strangle, 61, 64.75, 5 lots, maximum profit 15.40, maximum loss 34.60. This is how much it's going to cost us to put the trade on, and these are our break-even prices. So short straddle, run it when you are neutral, when you expect volatility to fall, and every day the time gets closer to expiry, you're making money, and that accelerates as you get into the expiry date. The maximum profit is going to be the combined total premium, and the maximum loss is going to be unlimited. So we don't trade short straddles or strangles for several reasons. One is you have to have more capital in your account. It's got higher margin requirements, and we really want to be protected in the case market does something unexpected. That's really the big reason why we do this. But why do you really spend money to protect? And this is the thing that people generally avoid when they're talking about these super high winning strategies where they promote 95% plus wins, as long as the market doesn't move too far away. And, in our time, we've seen a couple of these traders come and go in the market. Who shall remain nameless. But, there's a lot of things that can go and just be completely unexpected, once in a million year events, sort of like global terrorism or, sudden big increases in oil prices, inflation, deflation, earnings, guidance updates, rogue tweets by business and political leaders. This was, this is actually a slide deck was prior to...
I was going to say, so you put this slide deck together when it was 6,200.
Yeah.
Has anything on that slide changed?
No.
Nothing.
No, nothing. It's but it's funny, we can do this exact same slide deck in 10 years and there'll be some new Trump and there'll be some new dude, but trade war.
So apparently that's not an issue anymore.
No, the market's fine.
It was today.
It was today.
Today
it was okay. But you see, the thing is, if market does surprise, this is the best thing about it. So if something happens where you put a short straddle on yesterday, as Graham mentioned, you would have been gone today. This is where your broker's calling you up, forcing you to put money. You're going to have to come up with some excuse why you don't have it. But not on our platform. But with an iron condor, you're limited. It's all predefined, and you won't lose more than effectively the margin obligation, really, in most cases. So what we're going to do now is we're going to talk a little bit about half of the iron condor, which is really the sold spread components. Obviously, an iron condor can be thought about. You can put an iron condor in a way which is sell a spread when the market goes up, sell a spread when the market goes down if you're a range trader. And this is where Patrick can tell us all about. Oh, he's giving me the pointer, go, get off my chair.
Yeah.
Have we all sat in different chairs throughout this entire presentation?
We're using Ivan's crappy microphone. So
Okay, mate. Yeah.
Anyway.
Look, I'm in the process
very
of setting up my
sensitive.
new studio. There's only so much I could bring in a day, okay?
All right. So
Equipment's still a bit of
I'm going to move through this really quickly because I think more importantly we should be talking about the game, and we've covered a fair bit of territory. But just an example of, I guess, taking a trading strategy and applying technical analysis to it to have a view and then apply a strategy. So when we're looking at the moment, we're quite a lot of trades were getting very close to breakout, right? So they're sitting right below 52-week high, but to 52-week highs, and then we're looking at confirmation information that would tell us that, okay, this is truly a breakout that's worth getting behind. And so we ran a special session yesterday morning, and we're sitting there going, everything's close, but it's just not quite there. We are at a significant pivot point, and anyone that was on that session will be able to vouch for that. But we are right on a pivot point with a whole bunch of stuff, and it was either going to be, all right, it's going to break, or it's going to pull back, or it's going to consolidate. In the end, it's pulled back significantly. You know, it may well end up being a breakout in the next week or so. But what we look for here is and I'm pointing an arrow to on that particular day, that you can see the arrow in the middle of the screen, where I'll put my mouse over as well to help. On that particular day, it breached a 52-week high. So the next question we're asking, is the 50-day moving average above the 200-day moving average? It is, right? So it's a golden cross, which is something that trend traders look for, and we definitely look for on a breakout. Is the share price above the 50-day moving average? It is. Is the 50-day moving average trending up? It is. Is the ADX above 20? And you can't see the ADX on this chart, but it was, right? So what happens at that point in time is we would then set up a trade, which, and I'll just click through these, is called we call it a lit long, because it fits in with our leading indicator trend trading system. But it's an at-the-money bull put spread. So where Ivan was talking about an out-of-the-money bull put spread that you would use in an iron condor, this is an at-the-money bull put spread, where we can benefit from a move in share price. And if we get the move going in the right direction, we don't need a big move, and all of a sudden time decay comes in behind us, and we start benefiting from time decay. So a lot of, if you're talking about buying a call option to go long, time's working against you, right? Whereas an at-the-money bull put, we get a little bit of a move, and then time is our friend, and we don't need a massive move. And Graham showed a strategy earlier, a couple of strategies earlier, where you could say, well, I think it's going to go up, but I don't think it's going to go up forever. So I only want to benefit from it moving, a few percent. I can make good money out of that, but I don't need to pay for the ultimate open-ended upward move. Well, this is similar in that regard, but probably gives you a little bit more time decay. All right, so that's an example of us trading a breakout strategy. And then once we're in that trade, we're just watching the position, and our confidence levels are, the highest degree of confidence is that there's going to be a significant move, right? Not that we're going to pick it the first time around, but the move is going to be significant. So when we set the trade up, knowing that that's the case, we set the position so that if it goes against us, if it's a fake out, not a breakout, that we can actually switch our position and say, you know what, we're wrong. We're going to move ourselves into a bearish position. And the at-the-money bull put allows us to simply do that. We buy back our sold leg, and we're in a straight put trade, and giddy up if we're right. So anyway, there you go. So that's a trading a retracement, and it's quite simple. Now I'm going to switch across to the options game, but I'll just bring up the options game. This is the third for the year or the fourth for the year? Third, right? We've had some fantastic. I think it might be the fourth.
I think it's really.
Yeah, I think it's the fourth one. So
we snuck in the last one.
We snuck in the last because you had the
Investor
ASX
Day.
Investor Day. So for options games, we must have had like many thousands of people. The last game there were 1,700 people that played the game. And
getting more and more popular.
Yeah, well, the game is a way for you to be able to trade in the market and look using real market conditions and practice any trading strategy you want to practice and get real actual valuations on your trading, and it's the only way you can really do that in the options market. So optionsgame.com.au, if you're not already in there, there's prizes to win and the like. I'm going to switch now across. We're on a Mac, so I've got no idea how to use this.
Good. Well, we press what
Here we go.
Looks exactly the same like everything else.
So this is the first page before you click on that you get when you log into the options game. One of the things that I like to go...
I'm going to drive because you will totally destroy
you drive
this.
your Mac. I don't understand. But one of the first thing I always go and look at is the leagues. So you log in and this page here gives you information, there's upcoming events and so forth, but leagues. And when I logged in today and looked at when I logged in today, well, it's usually either your staff or my staff that are in the top 5 who spend way too much time playing the game.
I was wondering why Tim obviously has been banned.
He's been banned. One of my staff members, effectively won the game last time. He doesn't get any prizes. But I'm not sure at productivity. Tim's on the line tonight. Hello, Tim. Not sure his productivity was the highest it's ever been for that period of a month. But we have a lot of fun playing it and bantering amongst ourselves. But I logged in today as
one of our developers is number 3 before this.
Yeah,
before
Phil.
You talk this, just
on your Phil. Yep. And I just saw this trade. P&L today, $497,000. Now, the first thing I thought is this guy's a hacker. He's hacked the program.
We've had those.
But we've had a look, and it's a legit trade.
It's legit.
All right.
So you're saying you want to have a look at this?
I want to have a look at the trade.
Do you want to say please?
Show me the trade.
It's hard for you, isn't it? Yeah. All right. Well, we'll go straight into trade history, which is sort of our master view. And so have a look at the. I mean, this is amazing. And so it's a little bit out of sequence because there was a couple of trades done on the same day. But 25th of November, buy some put options. On the same day, it goes down from 16 to 23. From
down?
Sorry, yeah, again, I've got my excuses. From 16 to 23, up. Made 20 grand on that. Then on the same day, bought some calls. Got out of those on the 27th of November, 70 to 219, and then decided to go on and buy some puts. And today, up $497,000. The leverage that 320 contracts give you, or 450, sorry, short-term put options give you.
The only issue I've got with this trade is that
you've got one.
I've got a couple. Yeah. But the only issue I've got with this trade is that he's used up all his good luck on trading cryptocurrency equivalent options trading game.
But are you just jealous because he's going to win $500?
Yeah. Here's your $500 for your $500,000 trade.
That'd be interesting though, because it's only a 2.5% movement. And if we get a few more of those days, then he's obviously doing red-black at the casino. What if the market's up tomorrow and hasn't closed out the position? So you never know.
It does expire on the 5th of December. Yeah. So, and obviously X share expires in the morning.
Yeah.
So he's got a day and a half to survive unless he closes it down tomorrow.
That's exactly right.
Absolutely. Yeah. No, he's looking pretty good now. And this is the biggest trade we've ever seen.
Yes.
Yeah. So well done.
He's done excellent. And it just shows
killed it.
The little bit of the exponential kicker that you get from options when you've got something out of the money, it's moved to in the money, the delta changes and everything works in my favour. Volatility's gone up, delta's changed.
Yep.
I get that extra little kicker.
Yep.
It's unreal. I mean, the vol is the big shift there as well, and especially in the short term, just as it's coming down. But having said that, if the market goes nowhere, he'll lose 36,000. Not that he probably cares on a $500,000 day.
Yep.
It's probably more than my company's worth at this stage.
Yeah. I remember we had a client that had a similar sort of situation, and they called up and they were, giggling like a teenage girl at their profit and so forth. And the hard one is, how do you advise someone in that situation when they're in that trade? Because they're not thinking rationally. Anyway.
As long as it's an ADA2 accredited advisor, it's okay.
Yeah.
Give the option.
No profit unless you leave the casino.
That's right.
Yeah.
That's right. Yeah.
Anyway, that's an interesting one. So we thought we'd share that.
By the way, so going back a little bit to my futures days, I remember seeing people have these ridiculous profits. And what would be funny? So tomorrow, let's say the market opens up flat, and it would be that $36,000 worth of time decay would kick in, and they would literally be depressed, right? They've just made this amazingly large trade, and they'd be depressed because they didn't take the maximum profit. And I've seen guys go from really big profits that were right at a pivot point, effectively like getting along yesterday, right? And they'd just be sitting there, and they'd be like, as long as it just gets back to that 36 grand, probably, you know, I want to have that 421. What's he got? $640,000 in his virtual bank account now. As long as they get back to the 640, I'll close, and it just never does. No. And that's a very good expression for it, which I won't say online about, you know. No, I'm not going to say
Go
that.
on.
I can't. Don't push me.
I don't want to push you. You will say it. All right. So, I know you will. So the questions. Is there anyone's got any questions or anything you'd like us to run through? Now, can I we'll go and have a look at that in a minute. Now, anyone that would like to get access to the platform, our quant tested trade ideas, our education portal, or anything else, type in yes, and we'll organise to set you up with that. Whilst if you're playing the options game at the moment, you get access to most of the stuff that we've got. After that, if you would like to get a trial to be able to continue, or would like to open up a trading account, just type in yes, and we'll get that set up for you. All right. Any other questions? Anything else we can help with? Now, let me open this up properly.
That's I'm going to just try and figure out. Now, being a Russian man, I think I probably should answer this question about, is this a Russian roulette trade in your opinion? Well, the stats, well, actually, maybe that's a Graham question more than anything else, but the stats say that maybe not Russian roulette, but not too far away from gambling.
It would be more like having a 50 chamber and you load every chamber except for one, and then you shoot yourself and you don't get hit in the head. That's the kind of odds.
But you know, I remember there was an interesting story of a trader that I heard from one of the guys who used to run a broker before he sold it a couple of years ago, that there was this one guy who would every month buy a deep out of the money put option every single month, and he'd lose all the time, but the one time he made money paid for all the other losses. So he is, you know, Mark just said very black swan of you. The interesting thing is that, you know, if we're going to talk about black swan and Nassim Taleb type stuff, it is interesting, you know, the market does misprice the real fat tail risk, the very far end fat tail risk a little bit. So there is probably something in that. The only thing is, knowing from my personal experience, one of my things that I was doing has been buying puts, and the market broke out, and I stopped buying puts because the market's breaking out. And I was sort of waiting for the market to consolidate a little bit before I'd start considering doing it again. And of course, yesterday happens. Oh, sorry, today happens. Well, last night, I should say. You know, so the problem is if you don't religiously follow a trading system, what's the Pulp Fiction quote? You play with matches, you get burnt, right? That's sort of what I've experienced.
Yep, absolutely. And I guess I might go to the strategy builder here, and this is like quite an interesting one. So part of our system, and for anyone that would like to get access to our trade ideas, just type in yes, we'll get you set up for them, is the trading scans. So every day you can look at the market, and you can look at, is it a 52-week high beam? Is the 50-day moving average crossed over the 200-day moving average? Is it pointing up? Is the ASX above 20? Or you can press on trading scans, and it will do all of that analysis for you. Now, it was interesting, and Ivan and I ran a special session on Monday because there were so many trades just sitting below the 52-week highs, or just waiting for certain things to tick over, and we were waiting for the trades to occur. And I'm not sure if any of them actually met the rules for you to do the trade.
Well, the most important thing is we're waiting for today because you scan the market at 10:30, and of course,
but they weren't yesterday, so we were waiting today for confirmation, and it wasn't there, but it got so close. And it's why you have a trading system, and even if you got into the trade, that's okay. You've got a trading system.
The funny thing, it doesn't actually matter so much. The interesting thing about the trading system, again, we're looking for those 30 to 60 days, and last week a lot of these things would have presented, if not for the 30-60 day range. So everything was sort of sitting right outside of just before, because we want to be as close to the 45-day max time decay on our salt spread as possible. And it missed out, and we'll wait for some consolidation. I mean, the market is obviously still despite the setback yesterday, unless this was the high, which is highly unlikely, statistically speaking. It'd be interesting to see, you know, once it sort of gets back up there. unless of course this was the end and this is GFC 2.0 happening, which you know everyone always predicts.
But anyway, I mean, technically,
alternative history, no tweets. Then what? Love the comment.
the interesting point is the 50-day moving average. There is an interesting one, but it seems to have broken it quite a few times. So anyway, I don't think there's too much there.
It's been an interesting one. The 50-day moving average on the XJO has been a bit of a interesting, weird. I mean, I guess it makes sense. Being a diversified index, you'd actually expect it to revert to the mean more often than not.
Yep.
But then again, you know, trading through the GFC, I remember when it really never came back. So
yeah,
it left it, and it just the platform was far behind.
Yep, absolutely. But at the moment, the market still is technically looking bullish, and one day doesn't really change that. But we will see. Now, is there any other questions? Is there anything anyone would like us to cover? We've covered a fair bit of territory tonight.
Yes, we did.
There will be a recording of this session if anyone wants to go back over anything. There's another session next week which will be covering volatility. Probably look at some trades around volatility.
Risk array.
Risk array.
I did want to show this. So probably not the best place, but okay, I'm going to do something. Whoops, that's not what I wanted to do. So what I'm going to do is I just want to go and pick up someone with margin, someone in a margin call. Sorry for pointing out whoever this was. Okay, I'm just moving some stuff around on the screen. So going back to sort of the point that Graham mentioned, so the risk arrays actually show you, and there's a basic one and there's actually a more advanced one we can get access to, which is specifically stock by stock. This is sort of an aggregated view of your portfolio. But what you can do is you can hover over, and whatever the sort of the lowest point is will be ultimately your margin span scenario. So you can go here and you can say, okay, so instead of looking at it going, what's 3/3 or what's 2/3 or whatever, the point that you lose the most at will be your span margin. So in this case, if the market goes down to risk array 13, so that's 3/3 of a PSR, and the vol shock on the XJO is 35%, you're roughly going to lose 52,000 across your portfolio. So that's ultimately what your span margin's roughly going to be. Now, this is an aggregated version to give you sort of that shock between volatility up and down. And for those of you that are trading volatility, and again, we'll talk about this in more detail next week, but one way to really see your impact of volatility is to really, the wider the two lines are, the dark blue and the light blue, which is the vol up and vol down shock, that'll show you how much ultimately vega risk you have at different points in time. So what we've managed to do, and this was one of those really popular widgets for those sort of more advanced, in particular advisors who ultimately built it for, but the end retail customers that were sophisticated actually became the best users of this. You just gave people a really good visual aid as to what the margining system is telling them, and instead of them complaining about margins, which was sort of, as you know, Graham, a thing for a bit and still is in much less of a way now, they actually started understanding how important the span margining system, along with the volatility shocks, was to their risk management, and it really changed the way that they traded. And so a lot of people moved from short straddles to iron condors, for example, or at least protecting parts of the legs. And
so when we looked at that risk array on the bottom side, what was it, 50,000?
Yep, 53,000.
I can then very quickly be able to determine what my margin I have to pay with my broker, because my broker might charge 2 times ASX margin, 1.5 times ASX margin,
1.2.
all then gives me a very quick calculation of knowing how much I'm going to have to be up for.
Yeah,
great.
Yeah.
And how do I play around with that if I want to work out what my alternatives are?
So the interesting thing is that, so the way that people generally use this is really trying to see the rate of descent at different points. So the reason why that sort of comes spiking in, by the way, that's because the sort of the 15th and 16th risk scenarios are 35% of the overall shock. So in this case, what this is showing is the portfolio is generally long, and there's some margin around on that position. It's effectively synthetic long market-wise. And if you really wanted to go on and minimize your margin, you look at anywhere along this line, and you probably just start running a couple of what ifs. So you say, okay, well, if we go back here, I'm just again going to just try and minimize this stuff. So if we go sort of into a quick what if, we can see that really anywhere that we start buying a put option is going to start reducing our portfolio. So, if we do sort of 5 of those, we can see that we actually, despite us spending $3,756, we're actually going to get $16,500 back, improving our buying power by almost 13,000. So, and you can sort of start understanding where that is. So if we do, we're up to 16, you can see you're starting to get $37,000 back to do stuff. So in this case, actually, this is a pretty good example. Right now there is a margin call on this account. The client may be in a position where they don't really want to be paying that margin call. They just want to protect their portfolio against a further descent in the prices. This is sort of what they'd be doing. And you can sort of start saying, okay, well, if we do sort of, let's just say 20 loss just to be, 20 loss just to be exact, that's going to give us back $37,000. And then, well, let's see what the difference is if we do sort of 6,600, or maybe 6,700. And so you can sort of play around with this and get an understanding. And as you start going through this, you start seeing, okay, maybe I'll just minimize this. You'll sort of see that the portfolio, what it looks like now versus what it doesn't. And it's a really powerful tool for more advanced traders.
Yep, absolutely.
As they're managing their margin.
Nice.
Beautiful. All right, guys. Well, thank you very much for coming along today. We have another session next week. For anyone who's
tomorrow,
tomorrow morning. So tomorrow morning, if you want to come along to that session, the newsletter that you should be getting in the mornings will have an invite to tomorrow midday's trade group discussion, which will be an interesting conversation. I don't know what we're going to talk about.
Rally or fall.
But it'll be, obviously we'll be looking to what happens overnight and how the market opens tomorrow, which will give us some lead. There's a couple of trades that are sitting there that could be moving in as opportunities. So if you'd like to come along, the newsletter tomorrow morning you can book in. You can actually go to, if you look at your email account, you can be able to pick it up or off our website as well, book in.
Beautiful. Market is down. The futures are down 34 on the back of the lower settlements. So roughly 66.75 right now is where the futures are pointing at.
Yeah. So game players who are short, or just anyone who's short, is going to be happy.
Yep. Yeah. The account we looked at before is but
we'll see what happens.
Yep,
there's a long night ahead.
There's a long night ahead. Yeah. Trump will come out with something.
There'll be another sweep. Yep. Beautiful. All right. Thank you very much, guys. Much appreciate. Thank you for taking the time to join us. Cheers.